Learning how to analyze and value businesses is key to making great investments. Today, we're using the company Corsair Gaming as a case study. By the end of this video, you'll know practical steps to take in order to value any business that you're interested in. Next, people who say they can perfectly and consistently predict a company's future are full of garbage. If they could do this, they'd all be billionaires. No matter how you slice it, forecasting always has a pull it out of your rear end sort of component to it. It doesn't matter if you're a suit on Wall Street or if you're actually sitting on a toilet with easy access to your rear, there's some guesswork involved, plain and simple. When I was in grad school, I asked many professors in marketing, finance, and in economics about forecasting, how to go about doing that. When you boil away all their PhD mumbo jumbo, you were left with this idea that sometimes you just need to guess. And that's what you had to do then, and so you really shouldn't ever assume that pros know something that you don't. Even they have to make assumptions. With all of that said, there's just enough skill involved for it to be worth trying to figure out how to do all of this. So let's jump into the video. There's two primary components to analyzing a business: the core of the business and valuation. This video is going to primarily focus on the valuation component. Valuation is just a fancy way of saying how expensive something is, in this case, a stock or a company. To get us going, we're going to use the help of this spreadsheet that I've created. There are a number of these floating around online. A lot of them are similar. At the end of the day, these calculations are all the same, no matter where you get it from. And don't be intimidated by the look of this spreadsheet. I've done one on Apple here just so you could see what it looks like when it's fully filled out. Much cleaner. And again, we're only having to enter data into these gray cells here and then estimates into the yellow ones. And then everything else is calculated by the formulas that I've put in there. So Corsair Gaming will go ahead and start filling it out. We've got CRSR as our ticker. Next, for all this data, we're going to be going to the investor relations page for the company. Any publicly traded company is going to have the exact same filings on their website. So we'll just go to the financials tab, SEC filings, and we're going to find everything we need to here. They'll have all sorts of stuff, but what we're after today is the 10K. Since this is a newer publicly traded company, there's only one 10K. For older companies, they'll have a library of them. So we'll just click and download it. I've already downloaded it here. We'll scroll down to this table of contents. We're going to find the financial statements and supplementary data. So if we scroll down here, we'll find what we're after, which is the income statement. And we're going to input this data into our spreadsheet. So I'll go ahead and bring that up again. I'll fill out a couple just to show you where the numbers come from, and then I'll kind of warp the screen with everything filled out so we don't waste everyone's time. So back to the sheet, and we'll see that we've got net revenue, which is just our total revenue for the year. I'll go ahead and copy paste this over. And then you could go ahead and do this for all of the years that your company's got information for. If you go back all the way, you might need to download either a second or even a third 10K just to fill in the gaps with all of the data. So there's our revenue number. Next, we can go back and get our net income number. So here we've got net income, or if it's in parentheses, it means it's a loss. So we've got this number here. And by the way, if you're not familiar, a lot of these statements are going to be in thousands. So this isn't 103,000, it's 103 million. But we'll copy that over for net income. Coming down, we've got shares outstanding. So we've got a couple values here. The basic is just all outstanding shares. And then the diluted is going to be outstanding shares plus if there's any stock options that have not been exercised or any share-based compensation or shares floating around out there that aren't technically in circulation yet, but if exercised would be. That would be this value. And then you'll notice this is a weighted average. Other places in the 10K, you'll see a different number than this. It's just the up-to-date current number, not a weighted average throughout the year. So this is good enough for us. We're just going to go ahead and copy this over. All right, and that concludes this top portion, which is
information coming from the income statement. If we go back here and we find our balance sheet information, we'll be able to complete the next portion. So we've got the balance sheet here. Again, numbers in thousands. And just like with the income statement, we're just going to copy and paste the relevant information over to the spreadsheet. All right, so the first one we've got is current assets. So we've got our current assets here. They're itemized into different categories, but we're going to focus on the total current assets. So go ahead and copy this value over. And then same thing with our current liabilities. It's broken down and we see our total current liabilities. And we'll put that in there. So now we can see a current ratio value has populated 1.37. Then we'll go find our long-term debt. So we can use this number here for our long-term debt. And finally, our shareholders' equity portion. Right here, we can see total stockholders' equity for $37,390. Go ahead and copy that over. All right, so I'm going to put the rest of the data in here and clean up the spreadsheet to make it look nicer. Because the company is younger days, like I said, you're not going to get data for anything prior to 2018 or 19 for some of these cells. But you can see this, there are some calculations that have been made, and we'll be using that in our analysis further on. With that all out of the way, we're going to revisit this, but now let's move on to the next section. Today we're going to use Fidelity's website to compare some of the relevant metrics in valuing companies, but if you do not have Fidelity, I didn't want to exclude you entirely. So you might use a website like Market Chameleon where you can look at key ratios for a certain company, or if you have a subscription to other websites, any way that you can get access to this sort of information, you're going to be able to do exactly what we need to do. This is the research tab in the Fidelity website where you can compare different stocks or industry averages. I've got Corsair Gaming plugged in here, along with Logitech, another peripherals company within the same industry. Activision Blizzard is another company. Not entirely a perfect comparison there, but I do want to compare it to another popular company in the gaming industry. Microsoft, and then another computer and peripherals industry company, Xerox. In this valuation tab, we can see a bunch of different metrics. The ones I'm going to hone in on are PE estimates as well as price to sales ratio. We've got PE for the next year for Corsair Gaming is at a 16.3. This year's estimate's an 18.1. So you might think, okay, that's probably around where the S&P 500 is, maybe even less. If this company weren't growing, it'd probably be right in line with the market average. Maybe wouldn't excite you a ton. But we need to compare this to relevant metrics. So if we can see Logitech, which I'd argue is even a slower grower, it's got an even higher PE than Corsair Gaming. So that's kind of a green check mark for Corsair. Activision Blizzard, okay, it's got a 21. Microsoft, again, maybe not the best comparison. It's a supermarket cap company, but even that's trading at a much higher PE. So ideally, you'd see Corsair Gaming able to have higher growth rates in the next few years than some of these companies, but it's still commanding a very low PE. And then Xerox is kind of a fading company. They're definitely a low growth company and deserves this lower multiple here of 10.7 estimate. If we go over to this tab I've got open, it's just PE ratio by sector in the US. We can see down at computers and peripherals, which is Corsair Gaming's industry, we can see a trailing PE average of the 52 companies of 27.25 and a forward PE of 30.14. So we can just see right away this industry is commanding a higher PE ratio than anything that Corsair is showing. You've got a trailing 12 months of 20.7 And then, this year's estimate of 18.1 and then a forward P is 16.3. All of these are coming in low for the industry. If we look at revenue multiples, basically same website that we're looking at here, scroll down to computers, peripherals, same industry, 52 firms. We can see that the price to sales ratio that we're commanding here is 4.83. And if we look back here, we can see that Corsair Gaming's got a 1.53 price to sales ratio. So incredibly low. This means that you're paying $1.53 as a shareholder when we buy shares to receive $1 in revenue from the company. So an incredibly low multiple here for a growing business. I mean, this is like a shockingly low price to sales ratio. And of course, we're not going to buy a company just based on one metric alone. But when we start to take a look at the picture here, we can start to see that there's some attractive valuation metrics going on here with Corsair Gaming. If we move over to the growth tab on the Fidelity website, we can look at some different growth metrics for all of these companies. Just right off the bat, you can see red over here at Xerox. It's maybe a shrinking company, not something that I'd be attracted to myself. You can see that right away Microsoft's still commanding tremendous growth rates even at its enormous size. And then if we look at Corsair Gaming, Logitech, and Activision, we can see some moderate to pretty high growth numbers coming in for them. Because Corsair is newer days, I'm not going to completely rely on this category, and you can even see that when we go into the history here, some of these metrics don't even populate just because Corsair is a newer public company. It's been around a while, but newer to the public markets. Instead, I'm going to rely more on analyst estimates and adjust those in order to get the numbers that we're looking for in our chart. Let's jump back to the spreadsheet here, and we can take a look at some of the numbers we already have and then integrate some of what we learned from our analysis over on the Fidelity website to garner some valuable information. So right away, we can see that revenue growth is here. This last year, we had a lot of revenue growth, thanks largely to gaming increases, thanks to people staying home. Some bears on Corsair Gaming might say that, we're going to see a massive decline in revenue just because people are going to be back outside and they're not going to be playing video games. But for any young people out there, I think we all know gaming's not going anywhere, and strong brands that are owned by Corsair Gaming are not going anywhere either. So I'm really not concerned about declines in revenue. Now, are we going to sustain this 55% number? I don't think so. That's crazy, but the argument that we're going to start decreasing revenue is also crazy in my opinion. So that's that. We see that the company was losing money up until this most recent year, but not a lot. So it was right around break even. We'll just call it break even. And now it's a profitable company. And this tells us that, there's a substantial decrease in risk with this company because as soon as you become profitable, you're not at risk of constantly draining capital and having to raise money through issuing new shares or debt. And this provides a lot of security for the company. We see shares outstanding has increased. This isn't weird. This just happens. And over the life cycle of a company, over the first several years or decade or two, shares outstanding increases. And then slowly over time, companies typically start buying back shares and the shares outstanding decreases. This is just the normal life cycle. So nothing weird looking here. Next, we see current assets and liabilities. This current ratio is hanging in there right around 1.3, 1.4. This is a perfectly strong current ratio. Anything over 1 is not alarming. Anything over 1.5 is pretty good, and anything over 2 is great. So really happy with this for a growth company who's already got a current ratio over 1. Really nothing to worry about here. Especially when you consider the fact that it's already profitable. Next, you can see debt to equity ratio. I'm not really going to focus too much on that right now. And then we can see some growth rates, which really are unhelpful in this case, just because, again, the company hasn't been around very long. And because it's just becoming profitable, we're getting some weird numbers. But this is a fairly in-depth analysis of these numbers here. Hopefully that gets you thinking in the right direction. So as we move into the last part of the analysis here, we're going to have to start estimating different values here, and these values are going to dictate our projections for the future. These are all little levers, and when we pull the levers in different directions or make different assumptions, we're going to get different results down here, and you'll see these numbers populate in just a minute. So just a disclaimer, I'm not a financial advisor. This is not financial advice. I don't want you to take a look at this hypothetical analysis and use it as your analysis and then go out and buy Corsair Gaming. I'm just going to throw out some numbers here to show you how this might work. So let's just say you're assuming that the company is going to increase its share count by 5% a year. This may or may not be a reasonable number. You can go ahead and take a look more in depth to see if for Corsair Gaming this seems to be a reasonable number. Revenue growth estimate. So this is one where there's going to be debate. There's going to be people who think that Corsair Gaming is not going to be growing a lot, and that the gaming boom that's occurred because of people staying home is going to result in low revenue growth rates, and they might choose something very low single-digit number. Bulls on Corsair might think, wow, this company is phenomenal, terrific brands. It's going to be growing for years into the future. I'm predicting 30% growth for the next 5+ years. Okay, well, we don't know, but right now, this is coming from the company. We can see that the Q1 outlook is positive. The company gave good guidance. They've raised their revenue guidance range from 1.9 to 2.1 from 1.8 to 1.95. So when the company raises estimates, that's a pretty good sign. Right now, it's going to be a 23.4% revenue growth rate. Again, if you're going to really bank on the number you're going to be putting on here, you might want to look more in depth into what you think a reasonable rate would be going forward. It might be 15, 20, might be less, might be more. I'll just go ahead and put in a 20% revenue growth rate, and then we'll need a profit margin estimate. So this is essentially what's going to be going from what percent is making it from the top line, the revenue, all the way down to the bottom line, net income. Now, if you look at a company like Apple, who's got tremendous margins, you're going to see that this number is around 25%. If you look in low margin industries like airlines or auto manufacturing, this might be a pretty low single digit number, 3%, 5%. Even on a completely mature company. So it really depends what you're looking at. Now, in the next year or two, a company may not be achieving Corsair might not be achieving whatever number you put in here. This number I would kind of put in what I think it's going to be achieving by, 2023, 2025. Because that's when it's going to have more growth built into the company, and it's going to be able to increase its margin. So we'll just say 10%. And if you wanted to look to see what a reasonable profit margin estimate is for this industry, you could return back to this website here, and we can see that for computer and peripherals, we've got this column, a net margin of 12.48%. So if you wanted to assume that Corsair Gaming achieved this rate, you could put that number in this cell here. I'm just going to leave it at 10% for now. We have no idea if it's ever going to reach the average for the industry, nor do we know how long it's going to take for it to do that. And finally, we've got a PE estimate. What sort of price to earnings do you think Corsair is going to command? As we know, depending on the stage of the company, it largely impacts the PE ratio that the company holds. If it's a growth company, it's going to be a higher PE. If it is a mature company like Xerox, we saw a very low PE. So what do we think it's going to have? And what is it currently? We might want to reference that as well. So if we go back to valuation, we can see that Corsair Gaming is in that 16 to 20 range, depending on which metric you're using. So we already know it's below industry average as is, and it's a growing company. So if people start to value it more as a growth company, we could see that multiple increase. It could go as high as 30, 35 price to earnings ratio, or even higher perhaps. So it depends on how aggressive or conservative you want to be in your estimate, but we could just say 20 if we want to be fairly conservative. And then we can see all these numbers populate down here. Let's take a look at those, and then we'll tweak these yellow estimates and see how our numbers are impacted. We can see net income targets here for 3 and 5 years. And then with the estimated shares outstanding, which is calculated above, we can see market cap and share price also populate. These values here, these share price values, are then used to reverse engineer a price entry point that we would need to purchase Corsair in order to achieve a certain rate of return. So let's just take a look at if we were to increase, if we were very bullish and increase our revenue estimate to 25, we're going to have more higher profit margin estimate, a little bit closer to industry average. And then if the company is a higher growth company, maybe it's going to be commanding a higher PE. We'll just say it's a 35 PE. We can see that the impact on our share price is pretty dramatic, and some of the rates of return that we could be achieving over the next couple years would be very high. And then if you were more bearish and assuming maybe only a 5% revenue growth and profit margins of only 8%, and the PE doesn't change, it stays around 18, then we can see how dramatically these numbers get affected. So again, today's video is not showing you this is what's going to happen to Corsair Gaming. This is showing you how you would begin to analyze a company using a spreadsheet like this. Again, I created this one myself. There are a lot out there. You can use whatever you want. They're all going to calculate things the same way. But using an analysis tool like this, we're able to generate price targets. And I'm sure a lot of you people have heard analysts throw out price targets. You're like, what the heck does that mean? How do you come up with a price target? Well, this is essentially what you do. They'll be sitting behind big fancy computers, but at the end of the day, these are the types of models that they're running.
Well, that's it. This is my secret sauce, folks. There's more that goes into valuing companies, of course, but this video will get you about 90% of the way there. If you made it this far in the video, thank you so much. Please don't forget to like the video so my mug pops up on other people's computers. Until that next one, peace.